everyone. Today, let's look at the US investment grade primary market because after a super quiet October, the new issue market is buzzing with activity. Oracle can illustrate this trend. In order to finance an acquisition, the American tech giant was looking to issue $5 billion spread on 4 different maturities. Order books quickly filled up, and in view of the exceeding demand of $40 billion, Oracle decided to issue $7 billion. But the story doesn't end there. In addition to raising more debt than initially announced, the company benefited from much better yields. Between what was announced and the issuance conditions, the 3-year maturity saw its yield reduced by 35 basis points to 7 and the 10-year by 45 basis points and the 30-year, where the demand was at the highest, from 55 basis points. Investors who were interested in this bond, which offered a firstly announced yield of 7.46%, ended up with a yield of 6.91%. The difference might seem trivial, but it allows Oracle to save more than $400 million over 30 years in interest payments to bondholders. This tightening did not prevent the bond to perform well. Once issued at an initial price of $99.94, it rose to $101.30 thanks to a decrease in the risk premium and in the 30 US Treasury yield. How to explain this frenetic investor appetite? Well, October was a very quiet month as the volume of new investment-grade issues fell by 27% in the US. The week of November 7 saw activity soar. On Monday alone, 15 US issuers issued almost $25 billion. So Oracle with the $7 billion took the lion's share. So offer is returning, but also terms have become more attractive for investors. On average, risk premiums are at their highest in a decade, allowing, for example, to get a yield close to 5.5% for a credit as strong as Toyota on a 3-year maturity. Issuers, on the other hand, choose to print debt before the Federal Reserve raises rates again. The other interesting point concerns the favorite maturity of the moment. Oracle's 30-year maturity example is symptomatic and indicates that the market is beginning to understand that the monetary tightening cycle will not last forever, that inflation will peak before coming down, as will activity, which could slow and then lead the Federal Reserve to be more accommodating. This is certainly music of the future, but perhaps not far off, as the bond market seemed to indicate. Corporate bond strategists are predicting a comeback for corporate bonds as early as 2023. And in the light of this very active week, many investors are getting ahead of themselves. Thank you and have a good day.